Hey everybody, this is from my intro to accounting class. I had promised to do a quick video on one of the homework problems. So why don't we take a look at this problem here? It's one of the blank sheet problems, which hopefully is helpful to go through. This is problem number 14, example 2-9 on the blank sheet. So here we got a few things, right? So we have transactions. I'll make my screen bigger so maybe you can see this. We have transactions, right? So on August 1st, we billed customers for fees earned for $73,900. We purchased supplies on account for $1,960. We received cash from customers on account for $62,770, and then we paid creditors. So the first thing I would do for this is to kind of write down these transactions on a scratch piece of paper and understand what these transactions mean. So what are we trying to record? So on August 1st, if we bill customers for fees earned on account, that means that we earned revenue, right? So fees earned means we earned revenue. So we performed a service or we shipped a good. So we've earned some sort of revenue, and the revenue is going to be recorded in the journal entry and go to the income statement. But we billed the customers. We didn't get paid for these, right? So when we bill the customer, instead of receiving cash, we're going to record an accounts receivable. So off to the side, I would just make a note that when we bill customers for fees earned, we're going to have an accounts receivable because somebody owes us money, and we're going to record the revenue. On August 4th, we purchased supplies on account. We talked about supplies in class a little bit, but whenever we purchase supplies, it's an asset, right? So supplies are an asset on the balance sheet. So when we buy those supplies, we're going to increase an asset, which is supplies. And here, the key phrase is on account. If we buy something on account, that means we haven't paid for it. So there's a lot of terminology in accounting. So if we pay for supplies on account, that means we didn't pay for it. We're going to credit the accounts payable, which we'll show in a minute, for $1,960. In number 8, we received cash from customers on account. Now, this is where we might be getting some confusion, right? So if we bill customers for fees earned, we're going to increase a receivable and record the revenue. Here is an example of accrual accounting because we didn't receive any cash for those fees. So we're still going to bill the revenue, that's an accrual, and we're going to record an accounts receivable. When we get paid later on, we need to increase our cash and then decrease the receivable. Both of these are assets, and we'll show you the journal entry in a minute. But notice that the revenue was recorded on the 1st, even though there was no cash. And when we receive the money, there's no revenue or income statement impact. Instead, we're going to increase our cash and decrease our receivable. And then finally, we paid creditors on account. That means that we paid people that we owe money to. In that example, we are going to decrease our cash and also decrease the liability. So on a piece of paper, I would actually go and write down what we're doing, right? With either plus or minuses, the type of account, whatever would be helpful, right? So here, we're going to see the journal entry. So on August 1st, we billed for fees earned, which is revenue, and we billed these fees. So we're going to increase our receivable because we haven't been paid, and to increase an asset, we debit it by $73,900, and we're going to credit fees earned. We're going to credit fees earned, and fees earned is a revenue account. Oh, let me get back there. So fees earned is a revenue account. And by doing this, we increase an asset, and we increase revenue, which increases income, which increases equity. But the entry is to debit accounts receivable and to credit fees earned. On the 4th, we have our supplies. So in our course, we always say that when we purchase the supplies, we're going to increase the assets. We're going to debit supplies and we're going to credit accounts payable, which is the liability. On August 8th, we get paid for a receivable, right? If we get paid for a receivable, we're going to debit cash and credit the receivable. So we have an asset increasing in cash, but the receivable is decreasing because the customer no longer owes the money, right? So here we have a debit to an asset and a credit to an asset, right? So we have one asset increasing and another decreasing. But again, notice that if we bill without receiving the cash with accrual accounting, we could still record the revenue if we record the receivable. And then finally, we pay creditors. So if we pay creditors, we're going to debit the accounts payable and credit cash. We reduce the liability and we reduce the asset. So those are the journal entries. Down below, we have the T account. So the T account simply record the transactions. So for cash, there was 2 cash transactions, one on 8/8, which increased cash debit, and one on 8/11, we paid cash for creditors, right? 2 creditors. So we have a credit there. We have accounts payable. So accounts payable, it has a credit balance. So if we want to increase an accounts payable, we credit that account. So we had this transaction where we bought supplies on account. So we credit accounts payable in the T account. And then when we pay the accounts payable, we debit it, the 820, we decrease it. Supplies only had one transaction. We purchased supplies for 1,960. So the T account increases 1,960. Later on, as we use those supplies, we're going to credit supplies and debit expense, but the question doesn't ask us to do that, right? And then finally, we have 2 more T accounts. One is called fees earned, that's revenue. And the fees earned, we have one transaction when we billed the 73,900. And then finally, we have an accounts receivable. So the first transaction increased the receivable, debited the asset 73,900, and the second transaction that came up for receivables was a payment on the receivable where we actually credit the receivable, and so we have a credit to the accounts receivable there. So those would be our T accounts, and what we would do is, we would show the ending balance for all these accounts at the end of the period. So for cash, we would have an increase of 62,770, a decrease of 820, and the net difference would be a debit balance on the cash side. And that's it. So that's it for homework. Example 209. So here we went through the journal entries, right? And we went through the T accounts, and you can do this for both accrual type transactions, which are transactions that don't involve cash. And you can also do the same debits and credits for cash transactions. So hopefully this helped. I will post this video and let me know if you have any questions. Thanks.